I can't take it anymore with these growth stock investors. The growth stocks are crashing. They're melting down. And they don't know why. They say those stocks shouldn't be crashing because they're growing. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a website dedicated for microcap stocks that are hated and ignored by the investment industry. I also wrote 10 books on investing, one of which is available for a free download at microcapexplosions.com, so make sure you get yourself a copy. According to Bloomberg, about 1/3 of NASDAQ stocks are down 50%. Lots of pain, lots of misery. You know what's interesting? That if it wasn't for all the crying and screaming, I wouldn't even know that these stocks are down 50% because I don't feel that pain. My stocks are not down 50%, but this video is not about me. So growth stocks are down and people are surprised. I kid you not, they are surprised. They say, well, these stocks shouldn't be down. They don't deserve to be down because they're growing. Yes, these stocks are growing. But does it mean that just because they're growing, they should trade at just any price? Seriously, it's like saying college is good because college is good. So what? Does it mean that I should pay $1 million for tuition just so that I can take a few classes, learn how to drink alcohol, and maybe lose some virginity? Really? Come on, people. You are either an intelligent investor or unintelligent investor. There is no such thing as value investor versus growth investor. But however, there is such a thing as dumb investor versus a smart investor. What do I mean by that? This is discounted cash flow analysis. You have a stock price of $100, earnings per share $10. It's trading for a P/E ratio of 10. Dividend payout 30%. Growth rate for the first 5 years, 12%, second 5 years, 9%, discount rate of 10, P/E ratio in 10 years of 15. Based on those variables, the value of the stock is 188. Now, if I change the growth rate from 12 to, let's say, 20, and then from 9 to, let's say, 15, what happens to the value of the stock? It goes up to 335. It was much lower before. Now it's 335. If the growth rate is 5 and let's say 3, what's the value of the stock? 108. What I just showed you is that growth is a variable in calculating value. Let me repeat that. Growth is a variable in calculating value. It is not separate. It is not growth is separate from value. Growth is part of value. So if you are saying to yourself that you are a growth investor and not a value investor, I suggest that you get your head checked by a doctor. You can't pay any price for a stock just because it is growing. There are limits. I'm not saying that you should be buying stocks that are trading at 10 times cash flow or PE of 10 or 1 times revenue. No, I'm not saying that at all. All I'm saying is that when you are buying stocks, you should pay attention to what you are paying for them. For example, I don't have a problem paying $100 for a stock that is worth $50 today if I think that 5 or 7 years down the road, that stock is going to be worth more than what I paid for it today. Remember, price is what you pay, value is what you get. But I'm not going to pay $100 for something just because it's growing. There is no unlimited in growing. Growing is growing. Growing is better than not growing, but growing is not unlimited price. For example, PayPal stock is down about 50% from its high in July of 2021. I heard someone say, even PayPal is down. Does it deserve to be down? Hold on a second. Even at today's price, after the 50% haircut, PayPal has a PE ratio of over 40, right? And we're talking about not a super high growth flyer. We're talking about a stable, mature company. Yes, it's growing, but it's already mature. The super growth already happened, right? And it has a PE ratio of over 40 after the 50% haircut. The stock is not cheap. It's not super expensive. It's reasonable for a company like this. I wouldn't pay over 40 PE for PayPal myself, and that's because, I have better things to do with my money than paying over 40 PE for PayPal. But with that being said, the PayPal's valuation is reasonable. When PayPal's stock was about twice as much as it is today, the PE ratio was approaching 100. You know what this means? It means that if their earnings weren't going to grow anymore, it would take 100 years to get your money back through earnings based on the price that you paid for it. 100 years. Do you think today's investors have the patience to wait 100 years to get paid what they paid for a stock? I mean, outside of the fact that they would be dead before, do you think today's investors have the patience to wait 100 years? They can't even hold a stock for 1 year, let alone 100 years of waiting. I would like to get inside the heads of people that were buying PayPal at $300 a share, PE approaching 100. Did they think that they were going to buy it at 300, double or triple their money, and then sell the stock to someone else that was going to pay them 200 or 300 PE? But you see, they don't think like that. They don't think about valuations. They don't think about market caps. They're growth investors. The company is growing, it has revenues, it has clients. I'm going to buy it no matter what. That's how they think. Did you read this fabulous book titled How to Profit from the Coronavirus Recession? It featured various different stocks to buy when they were selling off during the coronavirus. And on page 37 of that book, I'm just going to read one paragraph. PayPal is a very good business. The company earns a respectable return on equity of about 15% with profit margins of almost 14%. The company enjoys a moat from its network effect, 281 million active accounts, and intangible assets, great brand. Because the company's minimal capex requirements, half of its cash flow is spent on buybacks. While the coronavirus made PayPal's stock cheaper by 25%, I wish it declined more because at the moment the valuation was about 40. In other words, the author included PayPal in the book because it sold off heavily due to coronavirus. And at that time, it had a PE ratio of 40, okay, which was reasonable. Now, if you bought it at a reasonable price and waited some months, you would have tripled your money because the company's valuation went from reasonable to expensive, and you can argue that it went as far as unreasonable. But you didn't overpay for it. You had some margin of safety. That's how you make money. That's when the probability is on your side. I bet that this book was, talked about everyone on CNBC because it was so great. It delivered such great value for the readers. Let me see who the author was. Me. No wonder nobody was talking about it. I will clean it up later. Anyway, let's get back to the video. If you pay an unreasonable price for a stock and you expect to double or triple your money by selling it to someone else who will pay you even more unreasonable price or ridiculous price, then all I can say to you is good luck, because the probability is not on your side. You don't have any margin of safety. If something is priced for perfection, or if something is priced at a ridiculous price, at some point, the holders of that stock are going to look at the portfolio, they're going to look at it and they're going to be like, let me see what it is that I own. They're going to start questioning what it is that they own in their portfolio. And also, because the valuation is so high, anything will make them nervous. It might be the slowdown in the company's growth rate. It might be the fear of the recession. Or it might be the fear of Fed raising interest rates. Anything might scare them. But you know what's even more scary than that? Is that once these people start looking at their portfolio and once they get scared and then once they start selling the stock is going to continue falling until new buyers find it attractive to buy it. Everybody likes to quote Warren Buffett by saying, be fearful when others are greedy and be greedy when others are fearful. But you know what happens in real life? People are fearful when other people are fearful. They are greedy when other people are greedy. So who's going to buy your overpriced growth stock when everybody is running at the exit at the same time? The stock has to fall low enough to incentivize new people to buy it. And those people that are going to buy it are going to be the logical, fundamental investors. You might ask, at what level would they buy it? I don't know. I don't know at what level would fundamental investors buy it. It all depends on the opportunities that they have in front of them in other areas. For example, if we stay on PayPal's example, at what level would I, Mariusz, buy PayPal's stock? I would say it would have to fall to a low level so that the PE ratio on that stock is about 15. So it would have to fall another 65% for me, Mariusz, to be incentivized to buy PayPal, because I have much better opportunities out there to put my money than to do it with PayPal at a PE ratio of 40. And just to be clear, I'm not saying that PayPal has to fall another 65% for value investors to buy it. I'm not saying that at all. I don't know. I don't have any idea. All I'm saying is that when you pay ridiculous prices for stocks and then people get scared because of whatever reason, the prices of these stocks has to keep falling until they incentivize logical and people who actually follow the be greedy when others are fearful and be fearful when others are greedy. Quote, there's not a lot of them out there, but the stocks have to fall low enough for them to actually put in their money to work. And I don't know what that level is. I'm just saying that for PayPal, for me, it would have to be another 65% down because I have such wonderful opportunities somewhere else. In summary, do yourself a favor. You work hard for your money. When you go to the grocery store and you spend your money, you pay attention to what you get in return for the money that you spend. The same thing with stocks. Don't just buy the stocks just because they are growing. Pay attention to what you are getting in return. Price is what you pay. Value is what you get. It's common sense.
Stuff that they hear, some of it's new, some of it's old, and a lot of it is common sense. And you were talking a lot about
all of it is common sense.
Right.
But of course, when people use the word common sense, what they mean is uncommon sense, because the standard human condition is ignorance and stupidity.